Does the thought of investing make your palms sweat? If you said yes, you're definitely not alone. Many potential investors, just like you, hold back from investing because of the myths that surround it. For a while, several misconceptions held me back too. But here's the thing, investing responsibly pays off quite literally. And that's why I'm here today debunking 5 common investing myths. The fact is, everyone should be investing to build wealth for the future. So it's time to wipe off that palm sweat and let's put these investing myths to rest. Let's dive in. Myth number 1 is I'm not an investor. When I ask people to describe what they think an investor looks like, I often hear a wealthy white man wearing a suit strutting down Wall Street. I wonder why that's the case. We often believe we can only be what we can see represented in the world around us. So when individuals don't see themselves fitting into the stereotypical mold of an investor, they convince themselves it's not for them. But the truth is, to be an investor, there is no mold for you to fit into. You see, while these stereotypes may mirror the institutional investors of Wall Street, they don't at all represent the faces of retail investors like you and me. Over the years, media has played an important role in shaping how we perceive money, wealth, and the faces surrounding it. Thankfully, many creatives are now challenging these stereotypes, because the fact is, these days, we can all be investors, no matter your age, your gender, or the color of your skin. Myth number 2 is you need a lot of money to get started. The idea that you need to have a lot of money to start investing is a common misconception that holds many people back from investing. In fact, a recent BlackRock Investor Pulse survey found that 53% of people don't invest because they believe they don't have enough money to get started. Many people believe investing is something you do once you're already wealthy, rather than something you do to get wealthy. And initially, I did too. The reason this myth exists could be explained by the fact that until recently, you had to buy an entire unit of stock to invest, which could have set you back thousands of dollars. Nowadays, thanks to fractional shares and new technology, you can buy a fraction of a share for as little as $1, and account minimums and crazy commissions are thankfully a thing of the past. Also, there are many investment options that require little capital to get started. For example, you could consider investing in low-cost index funds or exchange-traded funds, which allow you to invest in a diversified portfolio of stocks and bonds with literally whatever you have to spare. It is important to acknowledge that investing may not be possible for everyone right now. But when you're able to build investing into your budget, know that even a small amount each month can make a big difference. In fact, the beauty of something called compound interest is that the earlier you start investing, the more you can end up with, no matter how small your initial investment may be. By making investing a consistent habit, you can slowly build up your portfolio over time, even if you start with just a small amount today. Ultimately, the key to investing is to start early, make it a consistent habit, and stay patient. Don't let the myth that you need a lot of money to start investing hold you back. With time and perseverance, you can build a portfolio that helps you achieve your financial goals no matter what your starting point may be. We all start somewhere. Speaking of, I've just started my YouTube journey, so if you're enjoying this video so far, don't forget to smash the like button to let me know how I'm doing. And while you're at it, please consider subscribing to my channel, Maya, where I connect the dots and fill in the blanks on all things personal finance. Myth number 3 is investing is too risky. Investing does carry risk, and no one wants to lose money, so this concern is totally understandable. But keeping a wad of cash in your checking or savings account isn't the solution if you want your money to work and grow for you. In fact, thanks to inflation, holding on to cash might actually be the riskier decision in the long run. You see, checking accounts and most savings accounts don't make you any money, and inflation can eat away the value of your cash over time. At best, high-yield savings accounts offer interest rates that are typically less than or just enough to offset the rate of inflation. Therefore, while high-yield savings accounts are useful for safeguarding your capital, investing is what can help you grow your money. Sure, there's risks involved when it comes to investing, but guess what? You already take controlled risks every day. Crossing the street is risky, eating spicy food is risky, heck, even getting out of bed in the morning is risky. But we still do these things anyway because the potential rewards outweigh the potential risks. And the good news is, when you invest, you have control over the level of risk you take on. You can choose from a variety of different investment options. For instance, government treasuries are relatively low-risk investments. Corporate bonds and index funds are medium risk investments, while single stocks are seen as higher risk investments. You can pick a mix of investments that align with your risk tolerance and financial goals. Risk management can also be achieved through diversification. This means investing your money across different types of assets such as stocks, bonds, and real estate. It's also important to diversify within each asset class. One easy way to achieve diversification is through investing in index funds. These funds track a group of stocks such as the top 500 companies in the stock market and allow you to own a small portion of all the companies in the group. By investing in index funds, you can spread your money across many different companies and industries, reducing your risk of losing all your money if one company or industry performs poorly. As long as you understand your risk tolerance and take a diversified approach, investing is not too risky. With the right mindset and approach, you can manage your risk to a level you're comfortable with and grow your wealth over time. The next myth is you can time the market. I'm going to cut to the chase on this one. You can't time the market. One more time for the people in the back. There's no such thing as timing the market. If you've been scrolling through IG, Reddit, and even TikTok, you may have come across some investing advice telling you to buy low and sell high. This idea is known as trying to time the market, and it's something day traders attempt to do. Day traders rely on very technical analysis to place their bets with the goal of making profits on each trade. You should know that most successful day traders treat this as a full-time job, and it's not something you can do on your casual coffee run. And it's been proven that even the pros, more often than not, get it wrong. You see, the market is unpredictable. It's affected by so many variables that it's impossible to know what's going to happen next. Economic indicators, global events, and company news can all affect the market. While some people might get lucky, unless you have a crystal ball, there is no way you can consistently and accurately predict what the market is going to do. Instead of trying to time the market, consider using a strategy called dollar cost averaging. This approach involves investing a fixed amount of money at regular intervals, regardless of how the market is performing. So for example, if you invest $100 per month in a particular stock or fund, you would continue to do so regardless of whether the market is up or down. Dollar cost averaging is a better approach than trying to time the market because it eliminates the need to predict when the market is going to rise or fall. It helps you buy more shares when the prices are low and fewer shares when the prices are high, smoothing your purchase price over time. By using this approach, you reduce the risk of investing a large sum of money at a single point in time when the market might be at its peak. It also reduces the emotional stress that comes with trying to time the market and makes investing more manageable for the average person. Dollar cost averaging is a strategy that's easy and accessible to anyone. If you have access to a 401k account, you're already using this strategy. You put a little bit of your paycheck into the account each month, regardless of what's happening in the market. Again, the key to building wealth is to invest consistently and stick to it for the long haul. No need to time the market because even experts like Warren Buffett admit that you can't. Myth number 5 is it's too complicated. You know when you put off something for so long and then when you eventually do it, you realize, oh, that wasn't so bad. And then you get annoyed at yourself for wasting so much time putting it off and ask yourself why you just didn't do it earlier. That's exactly how I felt when I first started investing. I studied finance in college and I've spent my entire career in finance. But believe me, when I first started investing on my own, I was intimidated. It felt like I was trying to understand a foreign language and had to be fluent in it before I started. I was wrong. Investing in itself isn't complicated. It's just unfamiliar territory. What can make it feel inaccessible is the industry jargon. Once I eventually got started, over time, what I understood was the basic principles are actually super simple and straightforward to understand. Sure, there may be some technical terms you'll need to get your head around, but once you break them down, you too will see that investing is accessible to anyone who wants to learn it. Some financial professionals use jargon to create a sense of superiority and to justify their high fees. You don't need to be fluent in investing lingo to be a successful investor. In fact, it's often people that speak in plain and simple language that do it best. They're the ones that can explain complex ideas in a way that anyone can understand. So my advice to you is this. Don't be intimidated by fancy talk. Focus on understanding the basics and build from there. And don't be afraid to ask questions. We're lucky to be living in an era where there are plenty of great resources out there, from books to blogs to podcasts and YouTube videos that can help you learn about investing in a way that makes sense to you. Also, thanks to advances in technology, it's become easier to invest in recent years. Many investment platforms now offer user-friendly interfaces, allowing investors to easily manage their portfolios with just a few clicks. So don't let this myth keep you on the sidelines. With a little patience and a willingness to learn, anyone can become a successful investor. So go ahead and take that first step. Your future self will thank you for it. And there you have it, 5 common investing myths officially debunked. The stock market has historically offered an inflation-adjusted average annual return of 7.3% for investors. That's a much higher return than any checking or savings account can offer you. And while it might seem like a scary space to step into, it's a money-making vehicle that you can and should take advantage of. Taking the first step is always the hardest part. But hopefully with these investing myths dispelled, you feel more confident in taking that first step. As always, I hope this video has been helpful to you. If it has, please don't forget to like and subscribe. Thank you and see you in the next video. Bye for now.